I'll move it down. I moved it right up.
That's perfect. Well, I'm glad you did. That was probably good.
Okay.
Yeah.
Okay, let's try this again. Mustafa Bilkor, are you here?
I'm here. Can you hear me?
I can hear you now. How about Dimitri?
I hear.
Ali, I saw Ali. Let's see. Theo Delevard. Oh, there you go. What a concept. So Theo's not here.
Yeah.
Okay. Okay, Sarah.
Yeah.
Samantha. Greg Evans. Julian Froelich.
Yes, that's me.
Turner Gow.
Here.
Natalie Gregory.
Here.
Lucas.
Yes, right here.
Okay. Mary Harb.
What?
Pim Jansen.
Yeah, I'm here.
Evans Kiptum.
I'm here.
Lori Long.
Here.
Zach Magaha.
Here.
Kevin Mewison. Okay. Nyasha.
Yeah, I'm here.
Okay. Donald Nab.
Here.
Saw you. Senia Nyadanova. Okay. Emmanuel Odalui. Okay. Michael Parkinson.
Here.
So you all moved on me, so I don't know. This is not going to work. Okay. Rick Van Dyke.
Sir.
Where?
Yes, sir.
We shoot somebody or what happened there? Oh, okay. Never a good sound to hear when. Hung Zhuang. Nope. How about Yang Wang?
Here.
Gordon Zabrowski.
Yeah, I'm here. Hello, here.
Okay. Okay. As I said down here, this seems like this could be easier, but that's okay. We're making our way through it. We only have to do this today, and we'll be good. All of you by now should have seen all of your cases. Should have seen all your case studies. Couple things. When we're talking about case studies, a couple of the commonalities. We've talked about this already, but the issue that almost everybody has is clarity, clarity, clarity. I'm still seeing a lot of vague statements that are being made. At the master's level, you are expected to produce clear, concise information. I'm hearing a lot of people that are saying that they wish they had more room. Well, unfortunately, that's not the case. You don't have more room. So you have to use the space that you have. So my advice to all of you is you're going to have to consolidate and you're going to have to identify all of the issues, but you're going to have to say which ones are the most important and where do I spend my time. You can think of the paper and the case as though you've got so much real estate and you need to put so much stuff in the real estate. So what you have to do is decide what is the most important. Now that doesn't mean you don't talk about it. You need to identify all of the issues. Now this is going to be extremely important when we get to case number 3. Because in the third case, there's a lot of different issues that you could pick. And what you're going to have to do is, I will expect that you will at least identify all of the problems and then say, according to the data, this is the biggest problem. There's still too many of you that are saying, I believe this, I believe this. I don't really care what you believe. I want to know what the data shows. I want to know what the data shows. So you need to get out of the habit of saying, I believe and I believe that it should be this, because my first question is going to be, where'd you get it? Where did you get this from? Where did you get this from? Okay. This will be, the reason the third case is done in the order that it is done in is because I want you all to be able to, hopefully by the time we've done 2 cases, you should kind of have a little feel of how this is going to be. And the first thing you have to do is when you're doing your overview, you've got to say, these are the issues that are going on. I believe of those issues, this is the most important. And then what do you think the next question I'm going to ask is? Why? Why is it that way? Clarify why it is that way, and then we can go from there. Okay? The cases went up on average somewhere between, there were only a very few number of cases that went down. And if you did the same mistake again and did not make the corrections that I suggested, then your case score suffered. If you did pick up, if you did make the changes, we saw increases almost everywhere. So by this point in time, you should kind of know what is expected. And understand, I still haven't seen anybody who's citing enough. I still have not seen anybody. We're getting closer. We're getting closer to it, but we're not citing as much as you really should. And even some of you, there were a couple that only had 3-4 references. You should be accumulating references as you're doing all of these readings. Think of it this way. All of the readings that you were given are a source, And again, at the master's level, you really should be able to figure this out, okay? This shouldn't be something that we have to put examples out there to show, because clarity, explanation, and where'd you get your information? Where'd you get your information? And to be brutally honest, don't care about your opinion. What I do care a lot about is I care a lot about where you got your opinion and how your opinion was formulated. And your opinion should always be data. Data-informed decisions is what we need to look at. Does everybody understand?
Yeah.
Okay. Are there any generic questions? Ollie.
Why is the final case study only 170 points?
The final case study, probably because it's the old, I'll check that because it should probably be 200. Okay. In the online one, it's 170. All the cases are 170, but the discussion question, because we're doing discussion questions for the last group. Okay. Now, are there any other questions? That would be one reason why it is. I'll check it to make sure, because I want to make sure the points add up. If not, it'll go back up to 200. Okay, that's, I think, what I meant. But when we go back and forth between online and face-to-face, I don't give nearly, believe it or not, I don't give nearly as many participation points as I do when you guys are doing discussion questions. Discussion questions are worth almost 40% of your grade in the online session of this. Okay? But that's a good question. I'm glad. If you see something like that that looks weird, tell me. I mean, we could make mistakes, heaven forbid. Any other questions? Okay. Now, a couple things about the way that the rest of the class is going to go. Everybody should know this is our last face-to-face class. When we leave, when we leave here, everything we're going to be doing from there on out is virtual. And as such, the schedule changed. Remember when we went virtual before and I had you doing discussion questions? The discussion questions are coming back. So all of those comments I said about what you need to do in your discussion questions, you might want to go take a look at those again, because I'm going to be looking for those to be better than what they were last time. You will have what I call, there's 2 content. If I'm not mistaken, there's 2 content and one that is, I'll call it fluff. For the week 7, there's 2 discussion questions, discussion number 8 and number 9. And then number 10, what we will do for the last week, and the last week is kind of a short week, the way that it works. All I'm asking is that you give me some honest feedback. I did not like the fact that you picked apart my case. Well, that's kind of what I do. I want some constructive criticism, and we have actually learned a lot from the students. So in discussion number 10, you don't have to discuss with each other, but I do want to know what were the good and what were the bad, and what'd you think? What do you think? That's discussion number 10. Now, discussion number 8 and number 9, which we'll do the first week we come back after Thanksgiving, that's the one where you have to have your first post in by Wednesday. The first post for the second question has to be in by Friday. It's the same routine as what we did before. Make sure that all of your posts, your first initial post had better be 250 words, not 247, not 200. If you are right at 250, the comment I'm going to send you is, how can you expect maximum points for minimum effort? And that's, just make sure you make your posts long enough. And everything has to be substantive, which means you cannot, it will not count toward the 2 response posts, but you better do at least 3. You better, if you have 2 posts and one of which is, yay, Rod, good job. That's not a post. That won't count. That won't count. And trust me, if there's anything you know by now, when you do discussion questions, you will get feedback. I do not send, and I usually don't get involved in the discussion, but what I'll do is I'll send you personally comments that say, you know, this one doesn't count. you know that you didn't add any substance to this. Or if you use a citation, if you put quotes on it, cite it, cite it. Yes, sir.
If you give us feedback before the deadline, can we edit it?
There's no reason. I've already read it. I'm not going to change the grade. I'm not going to change the grade. The only thing that would hurt your grade in that is if you didn't meet the minimum. Okay, so like if you put in your initial post, and let's say that it was 200 words long and it's supposed to be 250, and I would say, understand you didn't meet your minimum. Well, if you went back and edited that, I'm not going back to read that. I'm not going back, because once I grade and once I say that it's a certain way, I'm not going back to look at this. But if I say, make sure to cite all of your quotes that you use, I'm not going to take points away for that. That's more of an ongoing thing. Make sure you don't do that again. Okay. But that's a good question. There really isn't a need to go back and fix them, because when I've read them, I've looked at them as far as grading. I've looked at them as far as doing that. So you can go ahead and do it if it makes you feel better, but I'm not looking at it. Okay. What else? Nobody is going to ask me about the final?
We're pretending like it's not.
Here's what's going to happen with the final. And here's what after some long thinking about it, you all don't understand how easy this final is. Compared to the cases that you've done, you're going to think this is a piece of cake. You're going to think this is one of the easiest things you've ever done. It's 6 questions long. It's all essay. I'm going to put the final exam out. The date that I will put it out is Sunday after Thanksgiving. Anybody want to venture a guess why I'm doing that?
We concentrate on that case study.
You get an entire week to do it. You get over a week to do it. Plus, I really kind of don't want you messing around with it. I kind of want people to get a little bit of a break. Believe it or not, I'll be grading about 100 papers with all the classes coming in. So, but I'm actually trying to save you from yourself. Okay, I'm trying to save you from yourself. I'll put it out the Sunday afterwards. I was going to put it out the Friday afterwards. And if people are really feel strongly about it, 2 days, if that means that much to you, I can do that. I don't care. Was kind of trying to help in that way. You will have ample time. The only advice that I will give, and we'll talk about this in our virtual sessions as well. The only advice that I will give you on the final exam is, if you think that I was bad about being concise, I only want a paragraph or 2. I only want a paragraph or 2 on this. And some of you are going to want to write dissertations on every single one of these 6 questions. They are of the type that you could write a long thing. Don't want that. I don't want that. In fact, I have actually taken points off in the past for people going too long. Too long. Concise. Executive summaries is what we're looking for. So the Sunday after Thanksgiving is what I am thinking I'm going to put that out. Now, let me set expectations as far as your case, because I'm really not going to see you all until then. The third case is due this Saturday. Yeah, Saturday at 11:59. I am not going to give you the cases back until after we have our discussion. And there's a reason for that. I don't want your discussion to be biased by my comments. So my goal is to have these things graded while we are on break. But I'm not going to put them out until probably Tuesday morning after our virtual session. Because the first virtual session that we have, which is, it's like 11:30, November the 30th. Yeah. On November the 30th, we are going to have a virtual Zoom session using the same Zoom address that we have before, and it is going to look, walk, and talk just like how we have done our discussion questions up until now. Everybody's going to get broken up into groups, and you're going to talk about the case. You're going to talk about the overview of the case. Now, hopefully, those have been beneficial to some of you, to all of you. I would think the comments that I got back before is that you all like the interaction with each other. So that's what we're going to do on Monday. On the following Monday, we're probably going to have a little bit of a discussion, but I'm not going to have class for very long, because what am I asking you to do during those 2 weeks? I'm asking you to do discussion questions, and that's how you're getting your points for participation. So I'm not going to make you do I'm not going to make you do discussion questions and then make you sit through a class. I do think we'll probably spend maybe a couple hours talking about the case 2 weeks from today. Okay? Everybody clear on that? Okay. Oh. So we will have 3 more sessions, one of which I envision to be pretty short. Now I know what will happen in the last session that we have. Help me understand what I need to do in the final. I'm not going to tell you what to do in the final. All I'm going to say is be short, be succinct, and cover the question. And I'll tell you this, every time I put this test out, should you cite in the final? When should you not cite? There should never be a time when you don't cite, okay? So cite, cite, cite. I mean, how many times have I been ranting and raving about citing, and I wouldn't say, well, don't, okay, all that other stuff, forget about what we said. No, cite, support your comments. And if you don't, you'll hear about it. That'll be the comments. The grades on the final are usually pretty high. 1, I'm not as picky on the final. And 2, if you answer the question and cover it, you should be okay. You should be okay, but read the questions. Read the questions. They're not that bad. They're really not that bad or that hard. Any other questions? Okay. Now, today, what we're supposed to be talking about is we are supposed to be talking about different types of analysis, financial analysis. What type of things do we do? So what we're going to do is I'm going to start out with, on your screen in Jefferson City, do you see this thing that says financial ratios?
Yes. Yes.
Hey, something worked. Hold the phone. Something worked. I'm going to start this video and then we're going to talk about it. If it works.
How does financial ratio analysis work? Let's discuss 10 of the most popular financial ratios that can help you find the story behind the numbers. What do you need to get started on a financial ratio analysis? You need an income statement, the overview of how much profit a company made during a year. You also need a balance sheet, an overview of what a company owns and what a company owes at a specific point in time. We will start off with financial ratios that only focus on the income statement, then look at financial ratios that only focus on the balance sheet, and end with powerful financial ratios that combine information from the income statement and the balance sheet. Performing a financial ratio analysis has a scientific element to it, finding data and putting it into formulas, as well as an artistic element, assigning meaning to the outcome of the calculations, and seeing the big.
So what that means is that while financial analysts and accountants and statisticians are the absolute worst at this, they'll talk to the numbers, and then when you say, what do those numbers mean? They'll say number big, number good. Well, is that a good number or is that a bad number? How do we know? So what you need to do from that, and that becomes the art. The science is easy. We can teach you numbers all day long. But if at the end of the day, all you can do is say, ooh, that's a big number. What does that number mean? And sometimes you're not going to be able to know all of the information just by looking at this. Sometimes, and I used to tell the accountants that worked for me, sometimes you need to get out of your seat and go figure out what's going on. Maybe you need to go look out on the floor and find out why something is going up. We'll take a look at some of the ratios. I've also got a PowerPoint that's going to talk about some of this stuff too, but we'll talk about that afterwards.
Picture. Part 1. Financial ratios that only focus on the income statement or profit and loss statement, P&L. Let's compare the income statements of two fictitious companies, which unlike real-life companies have nice round numbers in their financial statements. The first step in financial ratio analysis of the income statement is to make everything relative. Relative to sales, that is. Each of the cost line items and profit subtotals is expressed as a percentage of revenue. Let's see what the financial ratio.
So again, the math related to this is extremely easy. All we've got to do is say, there's our revenue, and the revenue is 100%. Okay, so if you look at what the revenues are, that's your base, and everything is a percent of this. So what this does is it makes it so that I can look at Walmart and mom and pop's shop down the way. And what it does is it puts everything as a percentage. So then the question would be, why are they different? That's what we're going to get to. Why? Now, we might not be able to tell why, but this might help us figure out what's going on with this organization.
Ratios tell us. Company A has a gross profit margin of 50%, Company B of 30%. So the gross profit margin is 20 percentage points higher for Company A. Company A makes far more margin than Company B on the products or services it sells. Company A has an operating margin of 21%, while Company B has an operating margin of 14%. So the 20 percentage points difference, 50% versus 30%, on the gross profit level has shrunk to 7 percentage points, 21% versus 14%, on the operating margin level. Net income as a percentage of sales, often called return on sales, is 16% for Company A and 8% for Company B. What do we zoom in on?
What you need to do, and this is where it's critically important when you're doing financial analysis, is nobody is expecting the analysts to know why. But what you had better do is, number one, they started out and they had a 20% difference in their margin, in the gross profit margin. So they got some of that back in SG&A and R&D, research and development. So what would be a question you would ask? Even more generic than that. She said, is it the interest? Why? What'd you do? What did you do? Imagine, if you will, if these were two divisions of one company. Wouldn't one want to know why the other one is doing better than the other one? And if one is doing better in SG&A and R&D, why is that? Why is that? Are you better at your SG&A? Or do you just not spend any? And it might be, look at the R&D expenses. The R&D expenses at one is 90 and the other is at 60. Should it be at 90? Are they developing as many products? Those are some of the whys. Again, we don't know that. We don't know that. The best we can do right now is guess. But does that mean you might want to get up and go talk to somebody and say, wait, what's going on here? How come you're like 30,000 or 30 less than this other one? Are you not spending the money, or do you not want to spend it? Do you not have the products to spend it on? What's going on? Again, financial analysis doesn't always answer all of the questions. A lot of times it asks more questions than it answers. But you got to go find out some of these things. So what it does, I know a lot of times when I was doing financial analysis, I drove people crazy because why are you doing this? Where are you going? What's happening here? And being able to have somebody tell you that is why we do this stuff.
For further analysis, let's investigate the difference between gross profit and operating margin. This is mainly driven by selling, general and administrative expenses. 20% of revenue in company A, 10% of revenue in company B. The non-manufacturing costs for functional departments like sales, marketing, finance, HR, sourcing, legal and IT are far higher for company A than for company B. This could be related to the industry each company is in, the company's strategy, or the level of efficiency that it has achieved. Could company A be overspending in SG&A, or is company B underspending? Hard to say just from these numbers, but worth investigating. On the research and development line, company A is spending more than company B. This is usually seen as a good thing, as today's research and development expenses hopefully lead to high margin, innovative products and services to sell in the future. Part 2. Financial ratios that only focus on the balance sheet. The first question that I always ask myself is, how is the company doing on liquidity? Is it likely to be able to pay its bills in the short term? Let's look at the current assets, cash plus items that are likely to convert to cash within a year, versus the current liabilities, items that need to be paid with cash within a year. A useful financial ratio in this area is the current ratio. Simply divide the current assets by the current liabilities. For company A, 400 divided by 200 is 2. For every dollar of current liabilities, there are $2 of current assets, a safe position from the perspective of business continuity.
Can the current ratio be too high? Can you have too many current assets sitting around? Why? You could be under leveraged, which means if you're under, he said you could be under leveraged. If you're under leveraged, what does that mean? Jefferson City, you're welcome to talk. No? She said you don't have enough money. That's not why you would be under leveraged. Your cash isn't working for you. If you've got cash sitting around and it isn't doing something and you don't have it in some type of a tax, there isn't a reason that it's in an area to earn tax savings, then my question would be, what are you doing with it? Why do you have a boatload of cash sitting around? Okay. How many of you, when you get paid, take your entire paycheck and cash it immediately? Good if you can, but what are we usually doing? You're using it to pay off stuff, and it's working for you. What is this? It's just an update is pending. Hold on a sec. We've got a computer that wants to update. I'm going to say not now. Yeah, that's what we need. Is we need updating computers. Okay, we're back. So, most of the time, when organizations have resources, you give an organization to resources in order for them to do something with it. Now, if it is sitting around waiting for a tax, if there's tax reasons why it's sitting in a certain area, I'm not talking about that. But if somebody has a boatload of cash, I know the first thing I would say is, what are you doing with it? Why aren't you using that to invest? Is it okay to have cash just sitting there? No, it's not. It's not okay to have cash just sitting there. It should be working for you. That's what some of this stuff is trying to tell us. So be careful when you see things like current ratio. What do we want the current ratio to be approximately? Anybody? or a little over 1. So let's say a little over 1, which means I can pay all my short term, I'm liquid. Okay, do I need it to be at 30? If this thing was at 30 or 50, I know what I'd be saying. Either you got a boatload of accounts receivable, which is a problem, because if you got receivables, do you have cash? Not necessarily. Okay, or you got a boatload of cash sitting around. And if you've got a boatload of cash sitting around, my comment would be, what are you doing and why? If there is a justifiable reason as to why, then fine. But the fact that it's sitting there should be worrisome. And that's part of the financial analysis is what are we doing and why do you have that? Okay?
For company B, 200 divided by 400 is 0.5. For every dollar of current liabilities, there is only 50 cents of current assets, a more risky position, for a supplier that is hoping to get paid. While on the topic of current assets and current liabilities, let's calculate the amount of working capital utilized by the companies. Accounts receivable plus inventories minus accounts payable. For company A, this is 150 plus 200 minus 200, in total 150. For company B, this is 50 plus 100 minus 300, in total negative 150. Company B seems to be getting paid by customers before they have to pay suppliers and holds a low level of stock.
That really truly is not all that abnormal. In the restaurant company, when I was the controller, we routinely would get the money from our customers because you don't put money on account in a restaurant. When you go there, if you're going to put it on account, you put it on a charge card, it's your own charge card. The restaurant's getting paid. We didn't have accounts. So what happened was within a day or two, we got paid all of our money. But I didn't have to pay for our food for another 15, 20 days. So what that meant is that my cash flow was that all of my expenses, I was receiving all of my money ahead of when I had to pay for everything. Now, don't look at either of these two as far as working capital. Working capital usually includes cash too. It's current assets less current liabilities. So the definition that he has in there, I would probably argue I would include cash as well. The reason you don't include cash is because what you want is the capital that you can use to work on something. Well, cash is also a capital. So I still would argue that you need to include this. But what you're doing is saying, what are you doing with your capital? And do you have enough to pay your bills? Do you have enough to pay your bills? Both are an indication of how you are using the resources that you are given.
The next financial ratio is all about the company's financing strategy. Does it primarily borrow money to finance operations or rely on capital provided by the shareholders? The debt to equity ratio can help you put that in perspective. For company A, 100 in borrowings, 700 in equity. So a debt to equity ratio of 1 to 7. You could call this a conservative and robust way of financing with a big buffer of equity that helps defend the business continuity of the company in case of future losses. For company B, 400 in borrowings, 100 in equity. So a debt to equity ratio of 4 to 1. For every dollar of shareholder capital, equity, there are $4 borrowed, which is possibly more fragile.
Is there such a thing as a perfect capital structure or a optimum capital structure? The answer is, come on. It depends. It depends. Can you have an optimum for this particular moment in time? And for right now, I'd probably argue you could. But as soon as you make that, does it change? Yes, it does. Yes, it does change. So what you have to do is you have to look at this as a moving target. Now, when they were talking about being fragile, if you have a lot more debt, then that means you are more highly leveraged. Highly leveraged is not an evil. People in the United States think is, never a borrower or a debtor be, and it's a terrible thing to have debt. It's not necessarily. We know now tax shields. There's tax shields related to this. I had a long discussion with one of my classes today about if you have no income, does the tax shield exist? If you have no income, what are you shielding against? So the answer to that is no, you don't have a tax shield. So is it better to take on more debt because the debt could be cheaper? Not if you don't have income. Not if you don't have income. Those are all things to consider. So when you're talking about debt to equity, and a lot of literature is set up so that debt is a bad thing. Debt is terrible. What debt does is it makes your organization riskier, because if I don't pay my owners a dividend, they might get mad at me, and they could, if they all got together, they could replace me from running the organization. But are people going to take stuff if I don't pay them a dividend? If I don't make interest payments, if I don't make payments on the debt that I owe people, are they going to come and get my stuff? They will take your stuff if you don't pay for it. Okay, if you don't pay on the debt, they'll take your machinery, whatever you have used as collateral, they're going to take your stuff. So don't get lulled into the fact of saying that there is such a thing as one is better than the other. It's different. One is riskier than the other, and that's what they mean by being a little more fragile. Fragile in the fact that all of that interest has to be paid. And if you don't pay it, they're going to take your stuff. They could make you file bankruptcy. They could make you file one of the various forms of bankruptcy. Okay?
A related financial ratio is equity as percentage of the balance sheet total. 70% for company A, 12.5% for company B. Based on the debt to equity ratio and equity as percentage of total, you could say that company A has low leverage, while company B has a high leverage. Part 3. Financial ratios that combine information from the income statement and the balance sheet. This is where you might see new storylines and connections, on top of what you discovered in analyzing the income statement individually and the balance sheet individually. Let's start with a big picture financial ratio called return on equity, which is net income divided by equity. For company A, 160 divided by 700, which is 22.9%. For company B, 80 divided by 100, which is 80%. On the return on equity metric, company B far outperforms company A. What is driving that? While company A has higher profit margins, as we saw in the income statement analysis, company B has a much higher financial leverage, as we saw in the balance sheet analysis. There is a third component to the return on equity calculation, the financial ratio called asset turnover. Asset turnover looks at how much revenue is generated by the company with the assets it has. For company A, asset turnover is 1. 1,000 in assets on the balance sheet generates 1,000 in revenue in the income statement. For company B, asset turnover is 1.25. Let's dig a little deeper into two key subsets of this asset turnover ratio. The first one is receivables turnover, the number of times per year that the business collects its average accounts receivable, the ratio between revenue in the income statement and accounts receivable on the balance sheet. 6.67 for company A, 20 for company B. Receivables turnover might be a bit abstract for a lot of people, so let's turn it into a more tangible related metric called days sales outstanding. How many days does a company need to wait before a customer pays? 55 days for company A and just 18 days for company B. The second subset of the asset turnover ratio is inventory turnover, the number of times per year that the business turns its inventory, the ratio between revenue in the income statement and inventory on the balance sheet. 5 inventory turns for company A, 10 inventory turns for company B. So what do...
Anybody want to venture a guess at where Walmart is? How many days turnover they have in their inventory? It's a huge number. They turn it over a ton. Think about what Walmart does. They deal in volume, right? That's where the way they live their life. So what has to happen? Product has to come in and it has to go out. It has to come in and has to go out. So what that means is I'm turning it over. all of these things like inventory turnover. In the restaurant business, we did not want to see our turnover get anything lower than right around a 52. Now, think what that's telling you. 52. If I turn my inventory 52 times a year, what does that mean I'm turning my inventory? Essentially weekly. How many of you want to have week-old salad? Okay, no, you don't. So we had some things that were longer, some of the more like flour and stuff like that. You can keep that for a little bit longer. But do you want to keep chicken for a couple of weeks and then serve it? Probably not. Probably not. So this was an extremely important, this inventory turnover ratio. We watched it by product. And if I saw that it was trickling upwards, or if I saw that it was going, if it was trickling up, I didn't care. But if it went down and all of a sudden it looked like somebody was holding on to a certain thing, that's usually when I made a visit to that restaurant. So again, the financial analysis was hey, we got a problem. What it did was it raised the flag and said, whoa, whoa, hey, come take a look at this. And then you get up and go find out what's going on. And this is a true story. We went into one of the restaurants, and instead of ordering, let's say, 200 pounds of flour, somebody who made the order added a 0. So they got 2,000 pounds of flour. They had flour everywhere. It was stacked up to the walls and stuff like that. And the restaurant, we saw their days go way down. And we went, and I remember I walked in and I went, what's all the flour doing on the wall? And why do we have it up and down and everywhere? And they said, we bought too much and somebody screwed up when they made the order, honest mistake. And I said, okay, what are you going to do about it? And what would you do in that case? Now remember, we had 7 restaurants. What would you do in that case? What I said is, did you contact any of the restaurants to see if they need any of this? No, we just figured we'd go through it eventually. And I said, how long is it going to take you to go through this? Oh, it's probably going to take 6 to 8 months before we go through this. Okay, help me with this. So what did the financial analysis do? The financial analysis identified a problem, and then it wasn't, oh, great me, because anybody who walked out there could have said, hey, there's a bunch of flour over here. And when I did that, I said, did we contact the other restaurants to see if they need some flour? And they went, oh, you know, we could probably get rid of some flour that way. And I went, you think? And they said, but how are we going to transfer the costs? And I said, don't worry about that. I'll take care of that. But did the financial analysis do what it was supposed to do? It identified the operating behavior. And in this case, people make mistakes. And nobody was upset with the fact that they ordered 2,000 pounds, even though that's a lot. And I said, well, when they were ordering it, when they were bringing it in, didn't you notice that there was like 10, yeah, there was a lot more than what you usually get. They said, yeah, we weren't really sure what happened. And I went, at that point in time, I might have went, hey, whoa, stop. Don't put any more back here. But then they saw that they did order it and they said, well, yeah, we've got it on the truck. We got to deliver it. And by not telling anybody, did it create a bigger problem than if they'd have worked with everybody else? And yeah, it was just, this was the comedy of errors of people not talking to each other and not working through a problem like this. So yeah, it happens. The analysis caught it. It just took too long to catch it.
Financial ratios tell us. Can we say, based on calculating these financial ratios, that company A is in better financial shape or company B is in better financial shape? Not necessarily.
What would I say to that? Jefferson City, how about we hear from you once?
Depends. Depends.
Good answer. What does it depend upon? What you mean by good is one thing. What? And what else? Define good. Define what are your goals? What are the goals of what the organization is trying to do? Is good to one person the same as good to everybody else? I know a lot of you heard in your papers and cases, don't use subjective terms. Don't use subjective terms, because when you say good, bad, indifferent, unless you say bad is defined as ... then you can say this was bad. But until you define it, you can't say that. Okay? So when we're talking about things like that, you've got to put things in context. Now, is it better when you're looking at these two organizations? Can you say that one is better or that it's different? Having all this debt over here in company B is, I don't want to say worrisome, but it's a lot more than the other company. They've got a lot more than the other organization does. Now, is that something to be worried about? This is one thing you got to watch with financial analysis. We are looking at these numbers for one period of time, one snapshot. Do you think that that tells the entire story of an organization by looking at one period of time? So what should you do? Trends. Look at trends. The first thing I would do when I was looking at this is say, I want to see more information. Has anything changed over the last period of time that we're seeing here? What if there was a management change? Could that have caused some of this stuff to be different? There's a lot of variables. When I say it depends, there's so many different things that it depends upon that you can't just lay hands and say, this one's better. We now say that this one is better. What you can say is based on the information we have, it does appear as though one might be stronger financially than the other, but I'd want to see a period before. And the next thing I would say is, what's your forecast? What's your forecast? And see if it makes any sense when you're looking at the forecast. Because if the forecast doesn't make sense, somebody's lying to somebody somewhere. Okay?
Fairly. Financial ratios do provide us with clear information about the financial footprint of a company and deepen your understanding of the strategic and operational story behind the financial numbers. In this video on financial ratio analysis, we covered 10 financial ratios. On the income statement, gross profit percentage, operating margin percentage, return on sales percentage. On the balance sheet, current ratio, debt to equity, equity as percentage of total. When linking the P&L and the balance sheet, return on equity, asset turnover, receivables turnover, inventory turnover. Financial ratio analysis is as much an art as it is a science. Want to learn more about business, finance and accounting? Then subscribe to the Finance Storyteller YouTube channel. Thank you.
I don't want to hit that, do I? I want to hit this. Boom. Come on. Okay. Now, I saw a lot of people frantically writing this information is in the resource section of your of Canvas. So I'm not going to go through this in a lot of detail because it basically does exactly what we just talked about. So when I want to see if I can do this upside down. Ooh, look at me. Look at all these ratios. Okay. These are all the ratios that we talked about. Actually, there's 13 of them here. He only talked, how many did he talk about? 10. So we got more. Haha. Okay. When you are looking, go ahead.
We don't see anything. The screen is not scrolling from this side.
Hold on. Now what do you see?
Ratios, yeah.
Okay. So as I said, these PowerPoint slides are out there in the Canvas under the resource area. All of these PowerPoints that I'm going to be showing you today are out there. Some of them just got put out there like yesterday or the day before, but all of these ratios, when you are trying to look at a company, the first rule of ratios is never, ever, ever say one ratio is good or bad. Or bad. Is it possible that a company could have ratios that look really good for 1 month and then the next month be really bad? Or have one, this is the one that I love, and this is what's happening to a lot of places right now. What we're seeing is that March, April, and May, especially March, April, and May of this year, What was the economy doing in March, April, and May of this year? Nothing. Nothing. Okay? So if that's the case, then what we would want to do is we would not necessarily want to look at March, April, and May to compare our numbers to. Are our numbers going to look way big compared to March, April, and May? Oh yeah, anything that we do is going to be better than zero. And by the way, if you haven't heard the news lately, have you heard the latest? This weekend, all the hubbub was that the new administration is talking about potentially shutting everything down from January to April, possibly, might be as anywhere from 6 to 8 weeks. Anywhere from 6 to 8 weeks. I'm not saying I'm an advocate. I'm just saying that's what we're talking about. That is what, whoops, wrong one. That is what we're talking about. Be prepared, gang. Why is it doing this? Okay, so all of these ratios, now I saw people scurrying trying to write all this stuff down. I gave you the math on how to do all of this stuff. There's all the categories. There's some verbiage on it. There's a financial statement, and I gave you all the math on how to do this. So you can track all of these things. This might be something that you might see in your future. Not to give anything away, but oh, I could possibly see a question like this on, oh, I don't know, what do we got coming up? Gee, what a concept. Might you need to know how to do some of these things? And I gave you all, yeah, I even give you a comparison. And some of this stuff should make sense. When you're looking at some of these ratios and we're comparing Walmart to Target, does Target usually charge more than Walmart? On average, yes. Do you expect to get a little bit better quality when you go to Target than Walmart? Is that why people pay a little bit more? So when you look at this and you're looking at profit margin, would you expect the margin on the individual sales at Walmart to be as much as Target? No, they make a lot on a little. They make a ton on a little, okay? So what they do is they have to make a lot. They make a little bit, but they do it a lot. They do it a lot. Their volume is where they make all of this stuff up. So, but look here, when we talk about asset turnover, whose turns their product over more often? Walmart does. Walmart does almost twice. Well, it's not quite twice, but it's a lot more. It's a lot more. So they're turning their stuff over quite a bit, quite a bit. Then when we go to return on assets, debt to equity, people make, and this is my personal opinion, I think too much is made of how your debt is compared to your asset, unless it gets way big one way or the other. And I think the way, as long as 60-40, yeah, 70-30, that's probably okay. What's the first thing I would say? Remember what I said about ratios? Don't look at one. Don't look at one, okay? Don't look at one and say, is this good or bad? I'm going to say it depends, and I want to see another period. I want to see another period of time. I want to see a longer trend. I want to see trend of this. Return on equity, that's basically, all of these things are what we use in order to do the financial analysis. Now let's see if I can, there, whoop, going the wrong way. No, I'm really going the wrong way. So, trend analysis. Gee, where do you think I got that? Okay, debt utilization, all of these things. Am I going the wrong way? Yeah, I am. Okay. I'm doing this upside down. I even gave you what would happen if you changed the price to things. Now, we had one of the restaurants do this. We gave the restaurant a 5% increase in their price. And what happened was they had a 3% increase in their bottom line. So what I said was, how did you not have a 5% increase? Because if everything else stayed the same, where did it deteriorate? Where did you lose some of that 5% that we gave you? And then we started to do some expense analysis to figure out where they did. And they thought that they could spend more on marketing. So they just started spending more. Hey, look, we got a 5% increase. Let's spend more on marketing. And I said, well, did that generate any more sales? Well, if all it did was generate this 5% increase in sales, then that means your sales were flat, right? Because I gave you the organization gave you a 5% increase in revenue. So if you had a 5% increase from month to month, that means you didn't have an increase because we raised your price. So, but if that didn't translate to the bottom line, then that means it deteriorated somewhere through the balance sheet. It deteriorated. So, and the income statement. So the first thing you would look at is, where did it deteriorate? Where did it deteriorate? Now, did the taxes go up? Possibly. Now, what we found was that marketing went up. Marketing went up, and the sales and marketing people got to the restaurant faster than I could, and they made them spend more money on marketing. And I said, well, you're not getting the return on that, because if you spent an extra 10% on marketing, what should that do to your sales? Increase something. Increase something. And I remember getting into some really good discussions with the sales and marketing people. Used to get really upset at me because I'd say, I don't mind spending money on sales and marketing. I'm all for it. But should I just spend money and then, talk to the wall because that's what I'm getting out of it? I should get something out of this. And when I say the organization should get something out of this. And if all it is, the warm fuzzy that, look at me, I've got advertising out there. What should you get? You should get increased sales. And if you don't get increased sales, did that marketing work? Was it effective? And I don't know how many times I was told, you're not a marketing person, you don't know what's effective. And I said, yeah, but you know what? Sales didn't go up. So does that mean your marketing was effective? Well, and then this is the other comment I was told. Yeah, but we're effective in other ways. Why do you do marketing? Why do you do marketing? And yeah, these were the kind of discussions I had very often. Why would you do marketing if not to increase sales? We want to get our name out there so that people know about us. To increase sales. We want people to know that the restaurants are here. To increase sales. Okay? At the end of the day, what are you doing? You better be increasing sales. If you're not, then what are you doing? Okay, now let's see if I can do this right way. One of the big areas that we deal with is you need to be able to explain what the differences are. And I've used this analogy before, but it's kind of like peeling back an onion. When you've got the onion and you start to peel it back, you go, whoo, look at that. It could be real stinky, not necessarily always smell bad, but what it is it gives you more information. You can find out more about it. Asking the question, why? Why is this stuff happening? Why is sales going up? Why did sales stay flat? Why did sales and marketing go up? What are some of the reasons for this? This is all the kind of stuff we're looking for. All the kind of things we're looking for. And I'm going the wrong way again. Okay. All of those things, all of those PowerPoints are out there for your reference. You are welcome to use those. And like I said, the hint I gave is you might see that somewhere in your future. You might need this. Like what? Like near future? I would like to think both. Okay, because I think everything we're doing now is longer future too. But I think I don't know that you'll necessarily, you might need it for the case. But I don't know about, I can see longer in that thing that's coming out on that Sunday after Thanksgiving. Okay, I definitely see it there. Okay? We are right at 7 o'clock. We've been screwing around with internet, and we've been screwing around with all kinds of stuff. Let's take a 10, and I mean 10-minute break. Okay? Everybody back here in 10. Oh, you. Give it to Holly. Holly, are you okay taking those? Okay. Did you talk to to Bailey at all about where he put those? He said something about he was going to put them in my box, and we'll find them. We'll find them. Well, if they're in my, if I have them, I'm just hold them until you come get them. Are you gonna send them to Noma? That's fine. That's fine. Yes. Yes. You can't say no. Everything that you do has to be data supported. You have to support everything that you say. You should not say my opinion is, because your opinion should be based on data. Should be based on some type of citation or some type of support. Everything you do all the time should be that way. You use your own words, but it has to say the data supports da da da, whatever it is. Mm-hmm.
It's like 6 months. Probably 8 months. No, they're still the smart. Yeah, they have something. Belgium, they're really things like it's just like best player, yeah, just below. Yeah. Yeah. Let's see. You said like only one year. China, even more. I mean, you don't need that machine. Yeah. Just see the Why don't you go to like one club? And then just push it. Yeah.
Right. Yeah. Yeah, of course. We have.
I also been like because it's summer, I also be because I will be yeah, I was just chilling.
That's fine. I got 20 points down this day. Yeah, I was like everything to her. And I'm like, she's sitting there 2 hours to read it. No. Yeah. No.
Okay, let's start to get back together.
So now she's finished. Yeah, I have like a 92. Like, yeah. I don't know.
But you need to do this. You guys.
But it's extra one.
It's
Oh, I would be.
you know, it's like you got a month points for each.
Okay. Okay, one of the other analytical tools that we can use is something called the break-even point. Now, the concept of break-even is essentially this. What sales do you need based on fixed and variable costs in order to break even? Now, do we do any business? Is there any activity we do to break even? Is our goal to break even? Jefferson City, are you with us?
Yeah.
Is our goal to break even?
Profit.
We want to make some type of a profit, right? Even nonprofits want to at least know where their money is going. And yeah, at the end of the day, nonprofits need to not be negative. Okay, so when we're doing break even, why do we care about what it takes in order to break even? If the break even is so high that we'll never achieve it, does that tell us something about the organization? Does that give us some analytical tools to use in order to say what it is? And here's another example. We had somebody come to the restaurant group, and they said they wanted to they wanted to run some submarine sandwiches. We were going to open a place, and those that are in Knoxville know of this place, Charlie's Subs, that are in the Westtown Mall. Okay, when it's a submarine place that's somewhat specialized in Westtown Mall, and one of the issues that you'll see with them, maybe not so much now as what it used to be, is when you went in, there never was 1 or 2 people working behind the counter. They had like 6 or 7 or 8 or 9. I mean, there were always a ton of people behind there, but the line moved pretty fast. And at Westtown Mall, the line to eat at this place, and again, before all the craziness occurred, they always had a line. You always had a line, but they always moved you through very quickly. So when they were talking about bringing that same franchise, they were going to bring the franchise down to Sevierville, and they were going to put the franchise in front of the Walmart that's right on that main drag. They had access to that building, which is now a Baskin-Robbins. Okay, so if that's the case, what they were saying is, how many subs do you need to sell in order to break even? And when we did the analysis, I was involved in creating some of the financial analysis for this. They said that they needed, on average, to sell 1,000 submarine sandwiches a day. And I said, okay, how many can you make in a day out of that operation, the operation that you had? And I went to the operations folk and said, listen, I don't know your operation. You got to tell me, how many can you make? And they said they could make, the most they could make on any day is 1,200. Now, what have I been telling you that Sevierville is like? It's very seasonal, which means you're going to have very, very low days and very, very high days. Now, if you know anything about mathematical averages, and the next comment I made was, I said, okay, let's do some forecasting. And how many sub sandwiches do you think you're going to sell, like on a Monday, Tuesday, Wednesday? Oh, about 400 or 500. And I said, okay, then that means on the weekends, you're going to have to sell about 2,500 in order to get to your 1,000 average. Well, we can only make 1,200 a day. So what does that tell you? You're not going to break even. You're not going to break even. So does that put the whole operation in jeopardy before you even started? Yeah. Their averages didn't work. Their averages didn't work. But by doing a break-even analysis, that's how we caught it. And we didn't spend a lot of time on it because the labor was too high. The amount of labor that they required that you had was like twice as much as what any of the other fast food restaurants that we had were. If you go to a Subway, for example, how many people are usually behind the counter? Maybe on a good day 2. But a lot of times you might only find 1. Usually they'll have 2 just in case something happens to the 1. Okay, like, I mean, it could be anything. It could be cut yourself, whatever it is. So you went from 2 to when we were talking about the Charlie's Steakery, they were talking anywhere from 6 to 8 people that they were going to have with roughly the same business. So are you going to need to sell more stuff in order to be able to pay for all that labor? That's what break even does for you. So for years, when I first got into business, I said break even is the stupidest thing in the world, because who wants to break even? Nobody. Nobody wants to break even because you want to earn profit. But if you don't know what it takes to even break even, how are you going to know if you can do enough to make profit? So in the situation that I talked about, if you can't do the 1,000 subs that you need to break even, then you're not going to break even. You can't. You can't. You physically can't. So I've got another video. This one's only like about a minute long. I want us to watch this. This one's from Investopedia. Of course, we have to watch an ad first. Maybe.
In general, when gains or revenue equal the money spent to earn the gains or revenue, you've hit the break-even point. In options, the break-even point is where the market price of the underlying asset is such that the option owner will not suffer a loss if he exercises the option. For a call option, the break-even point is where the market price equals the strike price plus the cost of the option. For a put option, the break-even point is where the market price equals the strike price minus the cost of the option. In the business world, the break-even point comes when a company has earned enough revenue to cover its fixed overhead expenses. The formula for determining the break-even point is total overhead expenses divided by gross margin percentage. AAA Widgets has $2 million in overhead expenses. AAA sells a widget for $10. The direct cost per widget is $6 per unit. This is a 40% gross margin. Thus, AAA must have $5 million in sales in order to reach its break-even point. That means that AAA will have to sell 500,000 widgets to break even. For a cash flow version of the break-even point, remove the non-cash expenses, such as depreciation and amortization, from total overhead expenses. By making this calculation, managers know the amount of cash they need to earn over a given time period in order to pay the company's bills.
Okay, hold on. Let's do this. Now I want to share. And I also, can you all see that slide that says break even, Jefferson City?
Yes. Yes.
Eventually this will come up correctly. There we go. Okay. There's not a lot to this analysis. This analysis is really pretty straightforward, because what we have to do is choosing a capital structure. The break-even earnings before interest and taxes is where the EPS is the same under both proposals of capital structure. We're not worried about that nearly as much as we are about, oops, I went the wrong way. What we are more worried about is we're more worried about when do we get to this break-even point. Now you can do break-even point in a couple different ways. You can do break-even point in dollars, or you can do it in units. Now when I talked just a second ago, I was talking about units of the submarine sandwiches that they needed to make. You could equate that into dollars. If I said 1,000 subs and the average cost of a sub was $6, what are the sales that you need? 6,000 a day. Okay, it's really not that hard. It's really not that hard to get to this. Okay, so I gave you some information on that. This is a PowerPoint that you have access to already. Okay, so we have that as well. What I want to spend a couple minutes talking about, and I'm going to unshare. Maybe I'm going to unshare. Okay. One of the things that I want the group, and I want both groups to talk about this, is one of the questions that we had is how would break even help an organization? How can break even talk to the strengths and weaknesses that are inherent with an organization? How can it do that? It can help define whether or not they should pursue an investment. What else? Yeah, she talked about setting costs and setting, you know, activity volume of what you can do in order to break even. There's one thing that this helps us set though, and this is one of the main benefits of break even.
Price.
I heard it.
Price of your products.
Price. Do we know that we're charging enough? What if I changed my price? What if I changed my price and went up? What is that going to do to volume? Usually when you increase your price, what will that do to volume? It's going down. It's going down. If I increase it a little bit, could I still break even? Could it still lower the break even point? Possible. What if I increase it? What if I reduce it? What is that going to do? My break even is going to go up, but I might sell a lot more. I might sell a lot more. Is it always from a marketing standpoint? Let's see if we got any marketing people in either room. Is it always a good idea to be the lowest cost provider? Why? Somebody said no, and I said why? Yeah. If you wanted to buy something, if they said quality might be connotated with cost. If you wanted to go to the cheapest place to buy something, where would we all go? Wally World. Wally World. Do we expect the highest quality always from Wally World? No. Now that's not always fair to Wally World. Okay, but for the most part, we don't go to Wally World to get the highest quality stuff. If you're going to buy something and you want the best quality stuff, you're going to go to other stores. Now, fill in the blank on what those are. There's a lot of them. But part of the reason people go to Belk, Dillard's, places like that, okay, do you think that the clothes are a little bit better quality at some place like Belk than they are at good old Wally World? Oh yeah. Oh yeah. And the customer service is what was said. Okay. I had a question once when I was in Walmart about like something electronic. And I said, is there anybody who knows anything about this? And they went, nope. Nope. And I've done some retail stints at places like Best Buy and Target. Best Buy, they actually make all of their employees learn about the product before they go out on the floor. So you can't just walk out there and go, that's a big TV set. And you know what? If you press the button on the side, you can turn it on. It's a lot more than that. Now, if you went into a Target, would you expect somebody to be a little bit knowledgeable? Maybe not as much. Now, okay, let's fast forward that to Best Buy. Would you expect that people there would know more? What about places like Apple? What do they call the people that work at Apple? I think that is one of the, they caught it. They call them geniuses. I think that is one of the most arrogant ways to call your employees in the world. But, and I have friends, and I won't say that I've never done this, walk in and try and stump the genius and say, okay, genius, are you that? Okay. But why do they do that? They're trying to differentiate themselves between other places. If I knew that I could get the same service at a Walmart, why would I ever go to Dillard's, Belk, Best Buy, Target? I'd never go there. So it depends on what you're competing on. So from a financial standpoint, when I'm looking at, okay, how come I'm spending so much for employee training at a Best Buy? Why are they spending so much more on employee training? So they can train their employees? I don't know. When I was there, and this was a long time ago up in Minneapolis, that's where they're based out of, is Minneapolis. When I was there, you had every week, you had to take a certain amount of training, which means they actually pulled you off the floor and made you go sit in front of a computer and learn about the stuff. This was before the days of flat screens TVs. So we're hauling these big, huge television sets. Now, why would they do that though? What would be the benefit? What would be the financial benefit for them to have trained employees on the floor? Not only that, but is it possible that I could sell more? Can I charge more for some of these things? Yeah, if we had some, even after all this training, we still had some people that would turn the TV set on and go, ooh, look at that. One of the things when I was doing this, and this is how long ago this was, we dealt with something called lines of resolution. You don't hear about that anymore. But what people used to say is they'd come into the store and lines of resolution meant more detail. The more lines of resolution, the more detail. But what you've got to have is if I've got a whole bunch of lines of resolution, I could have 8 gazillion lines of resolution. But if the feed that is coming in only has 1,000 lines of resolution, why do I need a zillion? It's the same thing as when you're talking about 8K, 100K, what is it now? I think they're doing 8K television sets. Well, what if your broadcast is only in HD? Do you need a 4K or an 8K television set? It depends what you want it for, and it depends. Are you going to upgrade at some point in time? One of the things I always talk to people about when I worked at Best Buy is you want to be upgradable. So maybe you buy a little bit ahead of the technology, but does that mean I need to buy something that has a bazillion of them? Probably not. Probably not. Find the happy medium. But financially, how does that help us? What that does is if I've got people that know what they're talking about, are people going to be a little bit more, I'll say, dependent on them in order to buy stuff? This is what happens at Best Buy. And I still know people that work there up in Minneapolis. People go into Best Buy. Now, again, before all the craziness happened, people would go into Best Buy and say, hey, could you show me this television set here? I want you to tell me what it does. And then they would say, oh, okay, this is great. Thanks. I want to think about it a little bit more. And then where do you think they're going? Online. Online, Amazon, and they're shopping this all day long online. And it was like, thank you for their information. So what do you think Best Buy did to combat that? They price matched what was online, but what you had to have was you had to have a printed ad. It couldn't be, because there would be people that would walk in and go, yeah, I saw this television set up here for like 50 cents. I know I saw it somewhere. And then they would say, well, can you produce the ad? Well, I feel in my heart that it was somewhere in there, but I can't really produce it. They're not meeting that ad. They're not meeting that ad. Now, if you had a piece of paper and it said 50 cents for this, okay, they'd sell it to you for 50 cents. They had to meet the ad. They had to meet the ad. And we would have some absolute craziness happen. We had somebody print a sign once, and the television set was about $1,000, and they printed the sign for 10 bucks. We didn't sell the set for 10 bucks because we found the sign. Somebody walked up and went, what is that? Yeah. All of these things, they can have financial impact. They can have financial impact. But what other things? Price was one of the main things. You don't know if you're selling your stuff for the right price. If your break even is way too high, what was one way in that submarine sandwich place? What was one way we could have gotten that break even down? Well, they wouldn't let us. Actually, the franchisee wouldn't let us do that. But what did we just say? So what if I increased my price? What if I said instead of $6 a sub, I'm going to charge $7 or $8? Well, I could look at my material costs too, because if I can get my stuff cheaper, the thing is you had to source it from the franchise, which we couldn't, we had no negotiation power there. So the only thing we could really do is deal with labor, which they wouldn't let us, or we could start to talk about the price. And if I raised the price, let me put it to you this way. In one of the restaurants, I said, well, if you keep raising the price of your chicken meals, you're going to get to the point when people aren't going to buy your chicken meals. And they said, oh, but a little bit of a price increase won't be that big of a deal. And I said, a little bit of a little bit of a little bit of a little bit starts to add up. And people aren't going to spend $100 for a plate of chicken. It's not going to happen. They won't do that. So what has to happen? They talk a lot, in economics, they talk a lot about substitutes. If I was really thirsty and I wanted a bottle of water, okay? If I was really thirsty, what do these things cost at a football game? At the UT game, these babies will go for 10 bucks, easy. Easy. And will people pay for it? All day long. All day long. Why? Because there is no alternative. It's this or you go thirsty. You go thirsty. That's about all you have. Okay? So what we have to look at from a financial standpoint is what financial tools do we have that we can use? Break even is one of those. All of those financial ratios that we talked about, all of the interpretive stuff that we talk about, but even break even. One of the best uses that I have ever seen for break even is to say, what if you could do 500 subs? What if you could do 1,200 subs? What if you could do 1,500 subs? The term of this type of analysis is called sensitivity analysis. And what you do is, what do you really think is going to happen? What's your best case? What's your worst case? And then say, okay, if it's the worst case and nobody goes, they shut the economy down like what they're talking about doing. If they do this, what's the worst that could happen? Well, it won't be good. It won't be good. What's the best that could happen? You could make a lot of money, but is it possible that you could oversell what the organization could do? Could you be too good? There used to be a commercial that was out, this was a while ago now, but somebody was starting an internet sales group. And what they did was they were all excited and everybody was sitting by the computer and they had one sale, blip, came up. And then right afterwards it went 2, 3, and then the counter started to go like this. And they went, uh-oh, we're selling too many. So what would that tell you? If you started to see something where you were selling too many, what could you possibly do? Raise the price. Because if people are willing to spend that much on it, are they willing to spend a little bit more? Yes. Some financially. What happens if you do that? I might not sell as many, but I'm going to make more on each one. Okay? We go back to what we were talking about before. Price is not always a motivator. Because if I'm the lowest price, if I say that I'm going to give everybody this water here for a penny, you're going to go, well, first of all, there's not much left. Okay. Second of which, is it worth a penny? Where'd you get that water? Did you sit at the tap and fill it in or what's going on? Okay. All of these things are things that there's a value associated with things. So financially, we might say that things are worth something, but we also need to look at the entire picture. Now, this leads into the next discussion question. When you are doing break-even analysis, and let's say that it's in your vested interest that you want to see a product succeed. You want to see that submarine place. Let's say that I got a bonus if that thing started. Would it be in my best interest to say, the cost of that, the cost of labor? We talked about the cost of labor. And we talked about the cost of the factors of production. Well, what if I said, well, how much does it cost to make that sub? 50 cents. Now, you would like to think there's more in a submarine sandwich than 50 cents. But if I lied and that made it look like it was a profitable venture and the company went in and I got my bonus, what does that tell you that I probably did? Is that very ethical what I just did? Is it illegal what I did? No. Is it immoral? All day long. Is it unethical? All day long. Do people do it? All day long. All day long. You will find, and in the restaurant business, what we had is the only thing that I could go off of to sniff, and this is where the financial folks have to actually pay a little bit of attention. Because if we had 2 places that were selling chicken, and one was selling them for $7 and the other was selling them for $8. First, I would say, why is it different? Are there factors of production that is causing one to be more? And we actually had a restaurant at one point in time in Knoxville. Labor was more expensive in Knoxville than it was in Sevierville. So we had to raise prices accordingly. Okay. But if I'm getting a vested interest off of this, if I am getting something, could it be in my best interest to fudge the numbers a little bit? And in the accounting term for this is cooking the books. Is it okay for me to be unethical about the way that I do this? Dead silence. Is it okay? I got another video for you. Let's share. There we go. Anybody want to venture which one I'm going to?
Yeah.
Okay, let's get started by talking about ethics in general. What is ethics? If you're like most people, you don't really spend much time thinking about the philosophy of it. But once in a while, it's a critical exercise that you need to go through in order to clarify your values and principles, especially with regard to the workplace. So, ethics are the basic moral ground rules by which we live our lives. Ethics is about right and wrong behavior with a preference to choose right over wrong. So, here's the good question. Where did you get your ethics? Was it nature, nurture, or both? I mean, we all have ethics. You can't be devoid of it. We all have a conscience and a self-awareness that helps us know right from wrong. Do you consider yourself to be ethical? How do you know? Is ethics situational or absolute? These are very important questions that you need to sit down once in a while. Is ethics situational or absolute? These are very important questions that you need to sit down once in a while and contemplate.
You all, whether you like it or not, are going to be the decision makers for the future. My generation is kind of there right now, kind of. Okay, I won't say we're making the best decisions in the world, but we're kind of there. You all need to think about what is right and what is wrong. If you knew, and this is my contention and my personal opinion, is there a dollar amount for every single person, whether it's Knoxville or Jefferson City, is there a dollar amount that you would lie? Is there an amount that somebody could pay you that you would say, okay, fine, I'll fudge the numbers. Okay, fine, I'll change this. Is there a dollar amount? What if somebody was going to give you $100 million?
I don't want to go to jail.
Well, I know there's a lot of variables that we don't know. My contention is, and there's actually stats to back this up. Most people, not all, but most people have a dollar amount out there that they might be willing to fudge a little bit. Okay? And I have seen people do some outlandish things in my auditing days. I mean, oh, come on. It didn't take much to figure this out. But is there a dollar amount? Is there a certain instance? Let me put it this way. I'll put it a little different wrinkle to this. What if there was a new drug that was out and you knew that it was going to save somebody that was near and dear to you? Friend, family, could be mom, dad, could be significant other. What if you knew that you had to fudge some numbers, but you could get that? Now, I'm not trying to get everybody to come to a moral compass, but at some point in time, is there a situation where you would be tempted? Okay, let's not even say that you would do it. Is there a situation where you would be tempted to do something like this? Financially, I've seen people do it for, there was one guy and all he was getting was like a $5,000 bonus. And he just he walked out to the he walked out to the shipping department. Actually, it was more like a $10,000 bonus. But he walked out to the shipping department and said, ship everything you got out here. He was shipping 6 months worth of product at one time. And the reason was so that he could get his bonus. You know how long it took us to figure that out? Within 2 days, we knew what the guy did. Now, I was in charge of payroll, and I went, man, there's a bunch of sales that went out. Boy, you did a really good job. And then I went, huh, when were those? I didn't know that so-and-so had some sales that were supposed to be shipped. I went and looked at the ship date, and it was 6 months ahead of time. And I went, somebody explain that to me? Can somebody explain what just happened? And it got real quiet. And the shipping person, their comment to me was, this guy was a VP. The VP told us to do this. Now, if it's a significant enough level, are you going to say, no, sir, I'm not going to do that? If it's illegal, maybe. If it's illegal, if it's immoral, maybe. And this is another true story. When I was in charge of payroll, I worked at a place, it was a relatively small manufacturing place. And there were 3 owners. One was in charge of HR, the other was in charge of manufacturing, and the other was kind of the president. He was in charge of all of it, okay? But the 3 owners made decisions equally. There was one of the department heads, actually he was the head of one of the divisions, had somebody in his family got sick. He had just been hired like a month or 2 ago. He had just been hired, and we had a policy in our company that nobody gets vacation for the first 3 months that they're there. Nobody gets it. That's not all that abnormal. Well, this person had somebody get sick, and like deathly ill. And where they were in Singapore. So they wanted to take 2 weeks and go visit their relative in Singapore. HR comes to me and says, we've got this voucher. They want you to pay him 2 weeks worth of vacation. And I said, he hadn't been here 6 months, 3 months, whatever it was, hasn't been here the allotted time. And they said, oh, no, we've got, one of the owners has signed and said it's okay. I'll never forget this. I was probably 2 months out of college. I went, not going to do it. Not going to do it. Not going to pay that because that broke policy. And if there was one thing in payroll you had to do is you had to follow policy. That's good. That's a good part about that kind of thing. It also could get people in a lot of trouble. Okay. Next thing you know, I get a phone call. And the phone call is from the guy who's in charge of the HR. And he asks me if I can come down to his office. And I'm like, I'll come down there. I'll tell you, I'll show you how we're going to do this because by gum, we're not going to pay this guy because that broke policy. He sits me down, and I'll never forget, the guy's name is Tom Jagir. He goes, you know, I am so happy that we have people like you in this organization to make sure that we follow the rules. He goes, I want you to understand, I will take full and complete responsibility for this. I will sign whatever you need, but this is a special case. He has a family member that is dying, and we're helping him get to, the Philippines, Singapore, I don't know, wherever it was, okay? I walked out, and you literally could see steam coming out of my ears. And I'll never forget, I went to my desk, and I'm like, and I didn't know what I was going to do, but I didn't want to cut that check. So I made a phone call to my dad, and I said, this is just wrong, and I'm ranting and raving. He goes, are you done? Is what he asked you to do, and you've heard me say this a couple times, is what the owner asked you to do illegal? Was it illegal to make an exception to pay a guy his vacation ahead of when he had something, a family emergency? Is it illegal? Is it immoral to do that? It probably would have been more immoral for me not to do it. Is it unethical? No. And my dad's comment was, sit down, shut up, and cut the check. And I went, so really, what do you think about that? Okay, from an ethical standpoint, was I staying true to my ethics? Yeah, I needed to pick my battles a little bit better. I will tell you that if I would have done something like that at Clayton Homes, that'd have been about a 2-second conversation. You cut it or you're gone, is what I would have gotten there, okay? You cut it or we'll find somebody that will do that for you, okay? You need to stay true to yourself. And all of you that are, if you have aspirations of going into some type of a financial career, you will at some point in time be asked to do something that looks weird, smells weird, acts weird. And when you do that, you have to say, am I willing, and this is another thing that my dad didn't say this, but another good friend of mine said, are you willing to fall on the sword for this one? Are you willing to take a bullet for that? Okay. Another example. When I was the controller of the restaurant company, I got a expense report that came in from the president. And the only one that could sign off on the president's expense report was the controller. And I'm looking at this and I'm going, okay, bought a bunch of champagne, whatever, spent a lot of money on dinner. Okay, he lived kind of high on the hog. Next thing you know, massage for two. And I stopped and I went, he didn't travel with his wife. We have issues here. Is that an ethical issue? And I went, well, first of all, who am I going to tell? I mean, it's a president. Who am I going to tell?
His wife.
These are business. He turned it in and he wanted us to pay for his expenses. And he had champagne for two. He had massage for two. He had all this kind of stuff. Extremely obvious what was going on. And I'm going, oh, great. I want to be implicit in this. So what I did was I went to the executive VP of Human Resources. This is a small company. You're right across the hall. And I went, okay, what are we going to do about this one? And he goes, do you really want to fall on the sword for this? And I said, probably not. Probably not. Was it worth quitting my job over? Now, there were enough things at that. There's a reason I'm not the controller there anymore. This was not the only incident like this. So are you willing to fall on the sword? Was it illegal what he did? Technically, reimbursement for an expense when he was away, was it illegal for us to reimburse that? No. Was it immoral? All day long. Was it unethical? All day long. And this is the only thing that I could do. The company actually was owned by the president's dad. So, and the dad would send auditors down like every 6 months. And what I did was I went like this. I went, I'm not telling you what to look at, but you might want to take a look at this. And I made doggone sure, and I went like this. And I said, I didn't give it to you, but if you randomly pick something, you might want to take a look at the receipts for this. Next thing you know, Dad's driving down from Knoxville to talk to son. And he, believe it, again, true story. The owner, the dad, comes to me and goes, why did you approve this? And the VP and I are standing there going, seriously, what did you want us to do? Are we supposed to confront and say, you lie and you know what? Because he was stealing from his dad. He was stealing from his dad at the end of the day. Now, was any of that okay from an ethical standpoint? No, 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 no. And when you get enough of that and you see behavior like that, there comes a point in time when you go, okay, if we continue to lie, I don't want to be part of that organization. There's a reason I'm not the controller there anymore. Okay, yes, I love the teaching and stuff like that. But there's a reason I'm not the controller there anymore, is because you come to a point when you go, stop right there. I'm not going to do that anymore. And there was enough of that where I finally did. I finally did do that. So ethics, is it a big deal? Yes. Now watch what we talk about. There's more to this.
Now let's move on to business ethics. What is that, and how is it any different from plain, ordinary ethics? Well, business ethics refers to standards and practices in the workplace setting. Business ethics includes societal standards of right and wrong, business ethical standards and circumstances, and finally, legal standards. Wow, it sounds like a lot more complicated than just thinking about your personal moral code. Here's the warning. Business ethics is often more rigid than personal areas. You may be flirtatious in your personal life, but at work, it's harassment. At work, you can't decide which rules are worthy of following. You can show up late for personal appointments, but not for work.
Two things. Number one, at Clayton Homes, and this is a true, this is still the way that they do things. If you are in your 90 days, which means you've just got hired there, excuse me. If you are within your first 90 days and you are late one time, they'll write you up, give you a written warning, and say, if you are late the second time, you come in and there's a box. You're gone. You're gone. Now, go ahead.
I was going to ask, can companies enforce that employees don't get into relationships?
Can they force that they don't get into? The answer is probably not. They can't force that.
What can they?
But what they can do is they can make you announce it, so that you have to. And again, true story. Same place, same guy that was having the massages when his wife wasn't with him. You want to guess who that person was? It was another one of the employees. Okay, so what ends up happening is things end up dissolving with the marriage. And I vividly remember this day. He got the divorce papers, and it was going to be a contested divorce. And there was a lot of money involved because these are pretty, I mean, they're kind of high rollers. Okay, so the executive VP and I go into the president's office and say, okay, we want to make one thing clear. If this thing comes to trial, if the divorce goes to trial and we get deposed, because what did we have? We had information of what he was doing wrong, and we knew it. And I remember going into his office saying, I'm not lying. I will not perjure myself. Now, was he having a relationship with somebody at work? Yeah, it was so bad that this person was in the marketing department, and things would just get approved from the marketing department because it was, she said this. And we're like, so all I got to do is have her name and things just get approved? This is the one when I talk about, oh, I feel it in my heart that this is the way to do things. She was the one who kept coming up with this. So what they usually ask you to do is they want you to be upfront about whatever relationship is going on. Because could it affect the business? Yeah, I mean, we were approving crazy stuff. The salesperson came up with an idea. Now track this through. We're talking about break evens. We're talking about stuff like this. The salesperson came up with a way to increase group sales. And what they wanted to do was they wanted to give a discount during October, November, and December. Well, do you remember what I told you October, November, and December is down in Sevierville? Very busy, to the point that we don't need the extra business. But when do the groups want to come down? When you need the extra business, okay? They want to come down. No, they want to come down when it's real busy. That's when they want to be there. So the groups typically take longer to eat, tip less, and the restaurants don't want them. So do they want to do that when it's really busy? No, it's like the opposite of what they wanted to do. So salesperson, this marketing individual who was having the affair, comes in and brings this proposal to the president. And the president goes, well, that's a great idea. Let's do that. And I'm going, whoa. Financially, that makes 0 sense. Why would we give a discount to people to come in and pay when they're willing to pay full price? Does that make sense to anybody to do that? No, it doesn't. But did we do it? Yep.
What happened with the marketing department?
Well, they ended up getting married. Okay. No. Well, I don't know because I got out of Dodge. I did not, wasn't around for that. My understanding is that they, she still was working there. And what they did was they went from not very well hiding the fact to acknowledging the fact that they were a couple. So in answer to your question, some organizations will say that it is a terminatable offense for you to have a relationship for somebody and hide that fact. Because could it, in the situation like I was talking about, did it affect the fact that he was approving things that made 0 sense because he was having an affair? Yeah. So the companies will usually like you to declare. it depends. It all depends on what level you are. Usually what they'll do is in the employment agreement, they'll say that if you do have any type of inter-office relations, that you at least acknowledge it. At least acknowledge it. I had a friend who met his future wife. They're still married, everything, I mean, nothing illicit about that, but they met each other when they were working. And all they had to do was go to HR so that HR knew that the two were working together and that they were working together, that they were a couple. They were a couple. You just had to acknowledge the fact. It wasn't that big of a deal. It was just acknowledging that it happened. Okay? Any other questions? Okay. Back to the video.
You can't just borrow things from others. At work, any borrowing without permission is considered stealing. And of course, you
think about the restaurants. Do you think that there might be some stuff that people could borrow? What type of things do you think people would borrow? Like dinner? Yeah, we had people that when they walked out would always walk out with containers. And we're like, what's that? Oh, it's leftover whatever. Well, the restaurant's still open. How is it leftover? Is it really okay to do that? No. We also had some cooks that when they cooked something, it would be one for you, one for me, one for you, one for me. We didn't really care. And actually, most restaurants will let the cooks eat a little bit, but not one for one. Not one for one. That's not healthy. And yeah, they were eating a lot of food. They were eating a lot of food. And this one dude kept, oh, somebody ordered a steak. Nobody out there is ordering steak. I don't know what you're talking about. Oh, I don't know where that order came from. Must have misread it. Guess who ate the steak? The cook. The cook ate the steak. That's not okay. And we also had somebody, this was not at the restaurant company. This was actually a place I worked at in Minneapolis. We saw the person backing up to the dock, and they were taking product off of one of the trucks and going right from their truck into another truck. And they were saying, what are you doing? And when they went, oh, well, I'm just going to borrow a little bit of it for home. How is that different than theft? I mean, you're just out, all you're doing is taking it from one truck to another, and that truck happens to be your personal stuff. And then we caught the dude selling it in another parking lot. And what it was toilet paper. They were unloading toilet paper from one truck into another. It was a smaller truck, and then the dude was going down the street selling it kind of black market. That's not borrowing. That's called selling. That's also called theft. And they got in a lot of trouble. They got in a lot of trouble for that.
You can't just say whatever you feel like saying in the workplace. You need to understand that ethics in the workplace is not subjective, but is clearly defined by your employer.
If it's not, it should be. So even things like what Ali was talking about relationships in the workforce, then if in doubt, ask HR. HR would be the place that I would go to and say, here's what's happening. I just want to be upfront. I just want to be upfront. Now, the smaller the place, the more unwritten rules you have going on. The bigger the places, they're going to have rules and regulations like you would not believe. When I was at Marriott, it was like that. Here, they can't see it. It was like that thick, the book. It was very thick on all the rules and regulations that you had. So yeah, there will be a ton of different rules. And this whole harassment thing, there was a court case. See if they can see me. There was a court case that ruled against an employer because what happened was somebody was looking at somebody and they said, ooh, that kind of creeps me out a little bit. And you went to a supervisor and said, dude's here staring at me and it's freaking me out. And the supervisor went, blow it off. It's no big deal. You had a thicker skin. Don't worry about it. Okay. You ended up going, no, it's really kind of creeping me out. I don't like this. You ended up leaving your job. You end up suing the company. They were held liable because supervisor blew off what you said about dude creeping you out by staring at you. Can't do that. Can't do that. There's a lot of this stuff going on with the Me Too. Some people would argue it's going too far. I don't think any type of harassment is okay. Personally, I don't see how we can say any of that stuff is okay. Anybody who uses any type of position or anything to dominate over somebody, that's not okay. That's not okay. Okay. But does it happen? All the time. I still think it's happening. Again, I'm not in the business world. I only see it at this level. I would say when I was working in the business world, we saw it quite often. Quite often. When I was at Clayton Homes, I could tell you stories. We'll leave it there. But there were people that all of a sudden their loans would get approved. And we wondered why. It's because they stayed late. Yeah, that's all I can say. That's all we'll go with.
So now let's talk about what your ethical expectations are at work. In the workplace, you are expected to play by the rules, abide by the law, be knowledgeable of right and wrong, give your best effort to the company, work cooperatively and honestly with customers and coworkers, to look out for the company's interests and not your own, and to show respect for people and property. People and property. This is what an ethical person does, and this is exactly what your employer expects from you. Although at times it may be difficult, it is expected that these things are done automatically, without prodding or training. For most of us, changing from thinking about ethics as it applies to our personal life to our professional life requires a change in perspective.
This is also a true story. But the first job I ever had out of college, worked at a place, it was a smaller manufacturing place. And when I got there, they said, we're really spending a lot of money on office supplies. We don't know what to do about it. So what we're going to do is we're going to give hyper little new guy over here, what we're going to do is we're going to lock the supply cabinet and make everybody come through hyper new guy in order to get supplies. And this was pens, paper, all this stuff. So they made the mistake of giving me a little bit of authority, and they gave me the key to the supply cabinet. And they said, we want you to track these expenses. So people would come up and say, hey, I need a pen. And what question do I keep saying over and over again? Why? I'd say, why? Because I need one. And I actually was so bad one time that I walked out to a supervisor. This dude had asked me for a pen like 3 or 4 times in like a couple days. So I gave him a pen the first time, didn't really say anything. Second time I was like, didn't I just give you one? And I kept track of what everybody got. I mean, they told me to do this. This wasn't only me. Okay, so I wrote it down. Then I went, second time, gave him the pen. Third time, I went, hold on a sec. And I walked with him out to his desk and went, open your desk drawer, pens all over. And I went, what's wrong with those? Oh, well, I forgot to go back to my desk. I just figured I'd get a new one. Here's the other thing that happened. And this was, I think, the impetus that they put me up to keeping track of this. Right around August, there was a huge increase in office supplies. Whole bunch of people needed pens and paper and pencils and all kinds of highlighters and stuff like this. Anybody want to venture a guess at what's going on? And it was every August, September, we'd see this huge spike. So when they did this and they put me in charge of it, what happened? Did people want to really fight with me? And did they want to deal with me in order to get this? You know what? I think I'll go buy the paper. I think I'll go buy the pencils. And what happened is the first year they did this, their office supply budget got cut in half. Now, they didn't say, oh, great, John. In fact, I thought what was going to happen is I wasn't going to make it to the car one day because people were getting mad. I can't even get a pencil out of this guy. But from a financial standpoint, was I safeguarding the assets? Yeah. Did I maybe go a little overboard sometimes? Yeah. Yeah. Okay. At that point in time, believe it or not, I'm a lot better than I used to be, but I did not know moderation. If you put me in charge of something, by gum, you better tell me why you need it. All I need is a pencil. Why? I just gave you one yesterday. I remember telling the supervisor that. I just gave you one yesterday. What happened to it? It went down 50%. Went down 50%. So
think of this as your professional perspective on the topic of ethics. You are a professional, regardless of your job. You are expected at all times to behave in a professional manner. As such, you need to consider your professional perspective. That is, you are fair and unbiased. You show respect for words and actions at all times. A professional listens to others and gets the facts straight. A professional does not go it alone but seeks assistance. It is important that
one of the best pieces of advice that I was ever given when I worked at Clayton Homes was Jim Clayton said, never go out on a limb alone. If you're going to say something or do something that is policy driven, should you maybe talk to somebody instead of just going off on your own? And like, even when I was doing that, you've already gotten your pencil. Should I have maybe told my boss what I was doing? Now, again, who told me to do this? I was put up to this. This was not me just saying, I'm going to be super office person. No, they told me to do this. But Jim Clayton said, never go out on a limb on your own. So if I am going to make a policy statement or a policy judgment, one of the first things you should do is let somebody know. Now, does that mean, hey, I've got to go visit the facilities. I need help on this. Is it okay if I go to your boss and ask him that? Goodness gracious. Okay. Use a little bit of autonomy for that. Okay. But if you're going to spend money, then tell somebody, at least let somebody know. One of the things when I was controller, I hated being surprised. So if you told me you spent money on something, I'd probably go, okay. But if you told me after the fact, it's kind of like, does that behavior sound familiar? Tell me something about after the fact. I'm not very, yeah. Okay, does that sound familiar? Part of being a professional is being able to look ahead and see what's coming. So if we do that, you'd be amazed. People will work with you. You do something after the fact, it doesn't work nearly as well. But listen to others. Okay, maybe sometimes I could do better on that. Show respect. Respect is a two-way street. Sometimes, if you are in the financial field, you're not always telling somebody great news. You're not always, like when I was in payroll, for example, people didn't come up to me and say, oh, thank you so much for the paycheck. We really appreciate the fact that the paycheck was done right. But again, true story. This was back in the 80s and the computer system messed up. We didn't do anything. The computer messed up and actually shorted somebody a dime. A dime. And this individual walks up to my desk and starts banging on, I can't feed my kids for a dime. For a dime. My solution was I went like this, took a dime, taped it, and handed her the check back and said, we're even, aren't we? Not the answer that they wanted to hear. They took the check, and remember, smaller company, and went straight to the CFO. The CFO, whose office was probably like maybe by the door outside. That's about how far away it is from my area, but we could see each other. Here's what I get. Can I talk to you a sec? I get called into his office and he goes, are we in the habit of taping money onto checks? And I said, when somebody's screaming and yelling and throwing a fit out here, yeah, I'll do that. And he goes, okay, did you look at what the problem was? And I did. I actually went to IT and we went through what the whole problem was. Did I listen? Did I show respect? Well, were they showing respect by throwing a fit and throwing a little tantrum over a dime? So it's two ways. So what I did was I said, and my comment to him, and again, this was my boss's boss's boss. This was like 3 levels up from where I was. I said, listen, I had to solve the problem. This person was screaming. Did I solve the problem? He said, yeah, but we don't want to get in the habit of taping money onto checks. And I said, well, I don't do that all the time. I said, that's the only time I ever did it. Okay, but did I solve the problem? And he went, that was probably a creative way to solve the problem, but I wouldn't make it a habit. And then I walked out and that's as much as I got yelled at for that, but was it the way to handle the problem? Yeah, the answer was to fix the problem. Here's what the IT people told me. They said, if you want it to be fixed right in the system, what we have to do is get the check back, void the check, and then tell them that they'll get a check on Monday. This was on Friday. Tell them that they would get a corrected check on Monday. And I went, hold on a sec. You're telling me that I've got this person who's screaming and yelling and banging things, that they have to wait 2 days, 3 days in essence, in order to get their paycheck. How well do you think that's going to go over? You what? Remember how I said this was the place where I was afraid that I was going to make it to the car? This individual probably would have found me outside. But if they're yelling and screaming about a dime, and I tell them that they've got to wait 3 days to get their stuff, so I went, we can't do that. So what we're going to do is we're just going to tape the money on and see how this goes. Yeah, so, okay. Was that unethical? No. Did I fix the problem? Yes. Was it the best solution? Maybe not, but at the time it wasn't. Now, nowadays you can cut checks on the fly. No problem. No, it was my dime. No, it wasn't. Nope. Nope. It was my dime. It was my dime because we didn't have access to petty cash or anything like that. So I just took it out. I just had a dime and I went, you know what? I went, shoe fly. Yeah, no, I didn't say it exactly like that, but I wanted to. I definitely wanted to.
You have ethical questions or concerns that you are comfortable going to someone else and asking for help. And finally, you maintain your professionalism no matter what happens. Understanding your ethical expectations and then seeing how your professional perspective helps you meet them is a starting point for ethical success at work.
Okay, good. Okay, how we doing, gang? We got a little bit, well, we got about 45 minutes before I'll probably let you guys go. But what I want to get out of this ethics thing is ethics is something that is internal in all of us. And again, my belief is that I do think that there is a limit when people might tweak a little bit. And think about it, if it was something that was near and dear to you, is there something that could cause you to maybe question or put into question some of your ethical thing? Like even that stuff, like I knew what the president was doing was wrong. I knew that and I fully appreciated that. But was I willing to quit my job at that time for it? I had a wife and kids and no, I couldn't quit. But did that expedite me maybe possibly starting to look for something else? Oh yeah. Oh yeah. There's only so much of that. There's only so much, you know, they talk about the ethical bend that you're going to do. You can bend a little bit, but when you start going like this and you're about to fall over, yeah, then you have to, there's only a couple things you can do. Quit. I could have done something legally. I could have contacted that guy's dad and said, hey, this dude is stealing from you. How would that have worked out for me? I can't see that turning out very positively. I told the only other executive who was at my level, I told the only other person that I could think of. And we basically decided, can't really do much about it right now, okay? So, any question about ethics? Okay. Financially, like I said, and I made this comment a little bit earlier, if you are working in a financial field, there will be a point in time when you are asked to do something that you don't think is right. That's when, remember we were talking about your moral background? What is your moral background and what are you willing to do? And if you're not willing to do what they asked you to do, what are you going to do about that? What if they say, if you don't do it, we're going to find somebody else that will? What if you have a significant other and kids that you're supporting? What if you have, I mean, we all have bills, okay? Can you just walk away from what you're doing and say, but I was morally right, okay? Is that going to turn out well for you? Maybe, maybe not. Maybe, maybe not. Okay. I want to go over I want to do the last video. I'm going to run the last video. This is kind of an overview. It talks more about financial analysis, and the video itself is called Financial Analysis, Easy and Quick. It's a little bit longer than some of the other videos, but this will kind of summarize some of what we've been talking about and kind of the whole crux of tonight, which was how do I look at financials and how do I make decisions? And what other tools can I use in order to talk about financial type things? So let me kick this one in.
Hi, I'm Jean Poussin, Board Evaluation. I've been running finance courses all over the world now for the last 20 years or so. And people often ask me, Jean, is there a quick 30-second way of actually assessing a business? Of course there isn't. But what I'll propose to you is a quick shortcut that you might find helpful. And I think to position this clip, you have to appreciate when we get to that stage, we've gone through the business, we've assessed the business, we know what it's about, we understand the industry, and there's also an important caveat in the sense that the business has not changed. It's selling roughly the same things to the same kind of people, and that's kind of important. So with that in mind, we've got...
One of the things that he's talking about is, will financial analysis be different depending on the company that you're dealing with? For example, when I worked at Clayton Homes, was the financial analysis that we did on mortgages different than when I was the controller dealing with restaurants? Well, yeah, it's light years different. I mean, I'm dealing with food on one, and I'm dealing with financial instruments. Are there different inputs that come in when you're talking about food as opposed to mortgage instruments? So what he was talking about is, in order for you to be able to do financial analysis correctly, you are going to have to do some research, and you are going to have to, experience is the best thing when it comes to learning industries. When I was I worked at Clayton before I was a controller. I had learned for a number of years the mortgage industry. And then I became the controller of a restaurant group. I didn't know a restaurant group. I didn't know what was a good and a bad margin. So if I looked at the margins that we were making on the loans and then tried to attribute them to the margins that we were making at the restaurants, it wasn't even close. I didn't do that. One of the first things I did was I got my hands on financials. Remember what I said before when we were looking at ratio analysis? I looked for trends, and I looked for what was this a year ago? What was this a month ago? What was it? And I looked for commonalities. And if something didn't look right, then I started to ask questions. And I would show up. You can ask the restaurant managers. I used to show up all the time. Why is that doing that? And I'm sure I drove some of them nuts. We had one that was across the parking lot from our administrative building. I would go over there, but he was a really nice guy, and I think he was good at kind of training me and helping me tell what's going on. So one of the points I want to get before we get into this too much is you can't do financial analysis if you don't know the industry. And it is different for every single industry. There might be nuances that are different, but it is different. It is different. Okay?
Through the accounts, unearthed nothing sort of horrific or spectacular. So with that in mind, let's proceed. So what we have here is a basic income statement of profit and loss of a business. What you expect to see is revenue, sales going up to a level that you can understand. As your cost of goods or cost of manufacture or cost of services go up, typically, if possible, and I appreciate it's not always possible, but by and large, you put up the cost to your clients. So what that means is the gross profit percentage or the gross profit margin, which is gross profit expressed as a percentage of revenue, year on year doesn't change much. Okay, changed by very, very small, minute amounts being mathematics. Likewise, as all your overheads go up, at least by inflation and sometimes more, you pass it on to your client through your prices. So this means that, like the gross profit, the operating profit margin likewise doesn't change from year to year, or not by much. And by that we mean operating profit as a percentage of revenue, as a percentage of sales. Finance costs, or interest, implies you've borrowed some money, and we'll come on that in a bit. That gives you profit before tax, and then taxation. Well, obviously all countries vary in their taxation regime. But because tax is roughly the same percentage every year, and if your borrowings haven't changed too much, for the same rationale as the above two, the profit after tax, or the net profit percentage, and again expressed as a percentage of revenue, typically would not change by much every year. And
here's one of the things that's going on right now. Right now, in the United States, the average amount of business tax percentage-wise that businesses are paying is right around 25 to 28%. It not too terribly long ago was 35.
That's just federal?
That's federal. That's federal. Yeah, depending on what state you're in, you can add more to that. Okay, so if it's 25 to 28%, and not too terribly long ago, it was 35. Well, in some other countries, their top rate is 20%. So if I am running a business and I want to, remember, one of our main goals of any business is to maximize shareholders' wealth, right? Am I maximizing shareholders' wealth by paying an extra, 15%, well, anywhere from 5 to 15% in taxes? Here's one of the things that the United States is going to have to look at right now. Let's put it this way, are taxes to businesses going to increase? Well, all indications are that we have an administration, a new administration coming in that is not what you would call pro-business. So what is that going to do to the taxes? Here's where it gets sticky. If I'm in business and I'm trying to maximize shareholders' wealth, and I can move my headquarters easily. Now, not all headquarters can be moved easily, but let's say that I can move my headquarters to a country that only has a 20% tax, or stay in the United States and pay, they're talking about it going up to 30 or 40%. Okay? What you gonna do? You're going to hang out in the United States because we're going to wave the flag and say, yay me? Or what is business going to, what is in the best interest of the shareholders? If you can. What he said was going abroad. And in this case, you would consider it. You would look into it at least. Now, what I'm worried about, and this is my own opinion, if that happens a couple times, there were already businesses that were lining up to move their headquarters internationally before the tax cut happened. And I'm not saying pro or anti-tax. There's good and bad to that. But if businesses move away, are you going to get that higher 40% tax? You're getting nothing. You're getting nothing. The other thing that is a little bit of a fallacy, and they don't get into it as much in this video, but if you raise taxes for businesses, what do businesses do? They employ people. If you make it more expensive for them to employ people, are they going to employ as many people? This is the same argument as there are some states and there are some people who are very pro this raise the minimum wage to a living minimum wage. Now, I'm not anti people making a minimum wage or a living wage. Not saying that at all. But what I am saying is do the math. If you, let's say the minimum wage is 7.5, it's a little bit more than that, but it's around 7.5 now. If the minimum wage goes up to $15, if I've got 2 people working at a place and the minimum wage goes from 7.5 to $15, how many people am I going to have working at that place? 1. Or the prices are going to go way up. But typically, if you look historically, every time minimum wage goes up, there's a almost correlation to unemployment and people get laid off. And then you can argue, Is it better to have two people that are getting a little bit of subsidy, or one that's getting all subsidy because you know what? They just got laid off. There isn't. See, that's the thing, is how much subsidy and what are they getting? Yeah, it's a lot of what ifs there, and we don't know all the answers to that. But is that a dilemma that we need to consider? Yeah. The other thing that I'm a little worried about right now, and again, they don't get into it here, but financially, if we close down for the 6 to 8 weeks, anywhere from up to, I've heard as much as 4 months, okay? What they're talking about is they're saying the government is going to have to come in and subsidize all of us because none of us will have jobs. Okay, if the government subsidizes us, how does the government get their money? Okay, so where are they going to get this? We are $2.5 trillion. Last I saw is it's heading toward $3 trillion in debt right now. And they're talking about a stimulus bill that will be anywhere, I've heard it as low as 2 and as high as 4. So think about this for a second. We're barely paying for this, paying for some of our debt right now, and they're talking about potentially doubling or tripling the debt. Does that scare anybody? Is that going to have financial implications? Gang, this is past social welfare. This is how, what I always say when stuff like this comes up is, it's a great idea. How are you going to pay for it? How are you going to pay for it? Have you heard the latest comment that came from the Senator Elizabeth Warren? You all are going to love this one. She wants, one of the first things Biden does is she wants them to pay off all of the student debt. Not a terrible idea. Not a terrible idea, but where's it going to come from? Where's it going to come from? And I know there are some people in one of these rooms that are probably from a country where they have higher taxes. When I moved down here, and I'll give you another great example of this. One of the reasons that I am in Tennessee right now is when I lived in Minneapolis. Minneapolis traditionally is one of the top 5 taxed states in the union. Okay, Alaska's usually toward the top, so is California. New York is right up there. And then Minnesota. Minnesota's right there. Well, if you drive around in Minnesota, the roads are perfect. There's no potholes. Are the roads perfect around here? Okay, up in Jefferson City, how was Russell Avenue last week?
Amazing.
It was all torn up. It's better now. It's actually pretty nice now. Okay. But can you live in a place, when I moved down here, Tennessee is usually toward the bottom 5. Can you expect to get as many goods and services here as you did up in Minneapolis? There were parks on every corner. Every development had at least 1 or 2 parks. Okay. We made a decision as a family. We went, okay, we moved down to Tennessee. It's not 60 below like it is up in Minnesota every once in a while. And you know what? We're going to get a raise just by moving. Just by moving. And I went, warmer weather, raise, sounds like a deal to me. And that's part of the reason why I moved. Could we get to the point where the taxes could get prohibitive? It's possible. It's possible. Right now, the statistics say your generation, maybe you and a little bit younger, your generation is more open to increased taxes than ever before because you know what? You want people to take care of it for you. That's, again, personal opinion. United States, do we really want people to take care of stuff for us, or who usually takes care of it? Brush your shoulders off. We're capitalists. We're going to take care of it ourselves, dadgummit. Okay? So this is a change in philosophy, but now our philosophy is changing. I believe they are. I believe they are. I think there's more openness to this, and we're seeing it. I mean, we've got things like this Green New Deal. Some of what they're talking about in the Green New Deal is not terrible, but the way they're going about it, personal opinion, kind of crazy. Kind of crazy. We're going to get rid of all cows. That was one of the things of the new Green Deal. We're also going to get rid of all airplanes. Good luck on that. Let me know how that works out. Okay. Let's go back to the analysis. The what? Oh yeah, yeah.
Unless there had been some changes in the business. So we have a profit. Well, good, bad. Well, good or bad in respect of what? Visualizing a balance sheet, and of course the real balance sheets are not presented in this format. This is for purposes of illustration. We have shareholders' funds, which is what the shareholders have put in, plus profit which they've kept back over the years. There could be long-term liabilities, long-term borrowings, and there could be others. And there could also, or there more likely to be some current liabilities, small short-term borrowings, trade suppliers, things like that. That's basically what funds a business. And those funds will be reinvested in fixed assets, property, computer equipment, airline, for example, aircraft for an airline company. And they would also have inventories and similar things for most businesses. So when we look at the profit, we ask the question, well, profit, good or bad, for whom? And I guess one of our starting points has to be the owners, the shareholders. So in the first instance, the shareholders are going to say, this is our capital. This is what belongs to us. And it's made up typically of two tranches, the share capital which they physically invested and profits which the company possibly would have kept back over the years. So sometimes this is called net asset value, sometimes this is called total equity. So I divide the profit after tax by this to give me what's called the return on equity. So the owners take a view as to what return they've had on their business. But then they further say, hang on a second here, not only as a shareholder you have my money, you've also borrowed money. And debt is just another form of capital. So let me judge your performance on the total capital that you have, which is a combination of the shareholders' capital and monies that you may have borrowed. There are wider issues here, but we're keeping it simple for the time being. And we call this return on capital employed, which is the profit on all the capital at the disposal of the business. And that gives you an inkling as to how well the company is actually using its capital. So, you borrowed money. How much? Well, how much vis-a-vis what? And one expression of debt is what we call gearing or financial leverage. We compare the total debt against the equity of the company, meaning how much have you, the owners, put in and how much have you borrowed. We call this gearing. Now, there's no magic figure here. I think what matters is, do we understand why that business is borrowing? Can we validate the presence of borrowings in that business? And unless you've had a major acquisition, a restructure, something extraordinary, typically businesses borrow for three main reasons. One, is there a loss? If there's a loss, it implies very simply expenses bigger than revenue. Someone has to fund that. Or capital expenditure. Capital expenditure meaning we need to replace fixed assets. And therefore we ask the questions, what have you bought? Why have you bought? But also how well you are using those assets. And one measurement, there are a few others, we call return on assets, which means just that, which is profit divided by total assets. How well are you utilizing the assets of the business? Another question we would also ask, which would possibly necessitate borrowings, is what we call working capital. Let's say we're dealing with a buy and sell business. It's probably easier to visualize. I buy my stock and my inventories today, and my stock and my inventories sit on my shelves for about 30 days. I make a sale and I give my debtors, my trade payables, 30 days to pay me. I'm out of cash for 60 days, from the time I made the purchase to the time I physically get cash from my client. My suppliers will come in. They might give me 30-day credit or 40-day credit. But for most businesses, it creates an imbalance. i.e., I'm out of cash for about 60, but I'm getting finance for about, say, 20, 25 or...
A little hint. If anybody has looked at the final case, that's kind of a big deal. That's kind of a big deal. Some of this whole payment stuff, and how people get paid, how you decide to pay, the whole capital structure and the whole cash management that organizations use is kind of a big deal. I will tell you, when I was the cash manager, one of the first things, this was back in Minneapolis, one of the first things they called me in, and I had been working there probably about a week. They called me in and said, our normal payment terms are 45 days. We want you to extend the payment terms to 60 days. And I went, is the company going under, or what's going on here? And they said, we want to manage our cash by not paying our vendors for 60 days. And I remember saying to them, isn't that going to make them upset? And they went, well, you can handle it. So what did the vendors see? Remember, I told you that I had just started as the accounts payable manager about maybe a week or two before this change was made. So they see new guy comes in and they're not getting paid. So what did they attribute they're not getting paid to? The new guy coming in. Oh, the calls that I got. I got called everything under, you name it, I got called that. But was that managing the cash that they're talking about? And when they were talking about here, they were talking about the 30 days and then the other 30 days that you give the customers. Well, if I don't pay people for 60, am I matching this up a little bit more? Yeah, but are the vendors going to be very happy with you? We were big enough. That company, by the way, that was the one that made the headphones for the football. They say Bose now because they actually sold out to Bose, but it used to say Telex Communications. That's where I worked. That was the name of the company. And they would routinely pay people. And if they didn't like it, they would say, too bad, so sad, hate that for you. And if we found, if it was single source, then I had to pay them. But if it wasn't single source, I'll go find it for somebody else. And all I had to do was move my product another place, move my sales to another place one time. You know who does this all the time? Walmart and the US government, because the US government and Walmart pays you when they want to, not when you want to get paid. We've talked about this before. And if you don't like it, you know what? I'll take my bazillion things that Walmart's going to buy and I'll come over here and buy it as opposed to buying it from you. They'll move it and just say, well, if you don't like my payment terms, somebody else will work with me. Okay, if you're big enough, can you do that? Yeah, but remember what I said before about illegal, immoral, and unethical? Is it a little immoral and unethical to do that? It's not illegal. It's not, there's no legal document that says that somebody has to pay that. You have, even though invoices might say 30 days, there is no written law that says you have to follow that invoice. It is called suggested.
That's true on your invoice. But if you have a contract, a payment contract,
but Walmart would never sign a payment contract that was going to be any more than like 60 to 90 days.
Understood, but in the government is going to pay too. But I mean, you have contract term, payment terms in your contract.
Yep.
Typically, so you negotiate those, and then at the contract time, you
yep.
one way or the other.
Well, no, and then it becomes illegal if you don't follow the contract. Okay, in terms like that, yeah, they would follow the contract. But see, I dealt with one contract when I was doing some consulting work with the government, and you had to go through so many hoops in order for them to even follow the contract that it took you the 60 to 90 days to get there anyhow. So yeah, they get you one way or the other. Okay, they'll get you coming or going.
30. I have what's called a working capital gap, and this would require funding as well. So we've established the presence of borrowings. I understand why you borrowed. And I guess the next question we have to ask ourselves is, can this business afford those borrowings? Now, there are a number of ways of looking at this. Going back to the profit and loss income statement, I have to pay the bank interest or finance cost. How many times is that covered by the profit? At least, is my interest safe on that level of performance for the year? That's one way of looking at it. A better way would be to look at the cash flow of the business. Essentially, we are saying, let me look at all the cash in during a year and all the cash out during the year. What is driving cash? What is absorbing cash? And hopefully in is bigger than out. And if not, why, and why are you funding yourself? Because it is cash flow that repays debt, absolutely nothing else. and we call this liquidity. And the cash flow of the business not only will support that the debt is capable of being supported, but also gives you a strong understanding of the overall cash position of the business. So in summary, if you were to write a financial report on a business, you might find the following structure and template very, very helpful. And we've seen those themes already in this very, very short clip. Growth: is the company growing? Increase in revenue: how has the company increased? Is that growth sustainable? Can they keep growing like that? Profitability: is the company profitable? And we measure those in the first instance of our margins. We looked at gross profit margin, we looked at operating profit margin, we looked at net profit margin, and we concurred year on year they shouldn't change by much. So that's one aspect, the margins of profitability. The second aspect is that profit is good for whom and vis-a-vis what? Well, one first question is for the shareholders to ask, how well are you making a capital work? We call this return on equity, which is profit divided by shareholders' funds. The shareholders asking a very valid question, are you making a decent enough return on our investment? But then a second question is posed in that, hang on a second here, not only you have our capital, you've also borrowed money, chances are. So I would judge your profit performance on all the capital at your disposal. And we call this return on capital employed, which is combination of what we've put in, i.e. equity, plus debt, what you may have borrowed. And we call this return, again, on capital employed. So profitability has two strands, margins and utilization of capital of shareholders and all providers of capital, which will be debt people. So a company has borrowed money. Why could it have borrowed money? Well, one area we call efficiency, i.e. the chances are it's invested in fixed assets. It's invested in assets. How well are you utilizing the assets at your disposal? And one measurement is return on assets. The second line of inquiry is apropos working capital, which we've seen already. Is there a working capital gap? And if there is it satisfactory? And does it need to be financed? And those two lines of inquiry talk to us about efficiency. So there has been borrowing. Well, this is what we refer to as solvency. How much have you borrowed? No magic figure. We call this gearing or sometimes financial leverage. Why have we borrowed? Explained by a loss and or working capital and or acquisition of fixed assets or assets, capital expenditure. And we seek to understand the presence of these borrowings. Next key question, can the company afford these borrowings? Only cash flow will tell us that. And this is where liquidity comes in, where we look at the entire cash performance over a year and we put very simply at cash in and cash out. And hopefully cash in should be bigger than cash out. If not, why not? And how is the company actually funding its business on a year-by-year basis? And finally, you may be looking at that business as an investor, and the last key point, I guess, is investment attractiveness, i.e. is that company worth investing in, given all the parameters that you've just seen. Et voila, doesn't take long, does it?
Okay. One last thing that I want to talk about before we leave here tonight is we've been talking about a lot related to finance and financial objects and financial and analytical tools. But one of the things that I want to make sure everybody is clear on is from an accounting standpoint, and all of us should have had some rudimentary accounting. Okay. There are 4 financial statements that are included in every group's financial statements. Can anybody give me an idea of what those are? What are the 4 financial statements? There's one. What was? Balance sheet? 2. Okay, hold on, Knoxville. Jefferson City. We've got income statement and we got balance sheet. What are the other 2 financial statements?
Cash flow statement.
Didn't get that at all.
Cash flow statement.
Cash flow statement. Okay, what's the last one? Is this what they talk about, crickets? Statement of changes in financial position or retained earnings. Okay. Now here's the question to everybody. Which statement is the most important?
They're all important. All of them.
Why?
They all tell a different story about the company.
They all tell a little bit different. They all have different indicators. Can you tell enough about an organization by looking at the balance sheet? Can you tell whether or not it is profitable operationally? We can't. Can you tell about the debt of an organization by looking at the income statement? You can tell a little bit of the interest. You can see how much interest they're paying, but can you tell whether or not they're highly leveraged by looking at the income statement? Maybe if the interest is high, you can say, okay, something's going on, but do you know how much debt they have? You really don't. You really don't. Either of those two, when you're looking at the balance sheet or the income statement, do you know where their cash is being spent? Where do you see that? Cash flow statement. Cash flow statement. Is it important to know where your cash is going? Yes, it's extremely important. Do you have to know where your cash is going in order to be able to know how to manage it? Yeah, when I was the cash manager, I spent all my time trying to figure out where's all this money going? Where's all this money going? We spent a fair amount of time trying to figure out how to get it in quicker so that we could hold on to it and not spend it as fast as we wanted to. That was the majority of my job, is figuring out when does it have to be paid? And if I scheduled it out correctly, what can I do with the excess? And I tried to invest the excess. And in some cases, we were successful in doing that. Didn't always make vendors happy, but that's okay. So that's good. That's good. That was, I think we talked about that before, but there is no one financial statement that is more important. The only one that is a summary of other financial statements is the retained earnings statement. Because where can you get that information? You can get the profits from the income statement. You can get the balance of your retained earnings from the balance sheet. The only thing is dividends. You really can't get dividends unless you look at the, maybe if you look at the cash flow statement. Okay? Any other questions? Comments? Okay. We're going to take attendance one more time, see who's still here. Is Mustafa still here?
Yeah, I'm still here. I'm here.
Don't know why we're laughing. Dimitri.
Right here.
Ollie is still here. Theo.
I'm here.
I heard him. Okay, Sarah.
Here.
Samantha. Right there. Greg Evans.
Yeah.
Julian.
Over here.
Turner Gaw. Okay. Natalie Gregory. Lucas.
Still here.
Okay. Mary Harb, I see. Pim Jansen.
Yeah.
Evans Kiptum.
Yeah.
Lori Long. Zachary Magaha. See you. Kevin.
Yep.
Nyasha.
Yeah.
As close as I'm going to get. Donald Nab. Senya. I see her. Emmanuel.
Yep.
Michael Parkinson. Rick Van Dyke.
He's just went to the restroom.
Okay. Hung Zhuang. Yang Wang. Okay. Gordon Zabrowski.
Yeah, yeah.
Peter.
Rick is here.
Here.
He's back now? Okay. Okay. Now, The expectation for your cases will be that every case will be turned in before Saturday at 11:59. Don't let the internet be a reason that you are late on this, because the internet really isn't an excuse. If the internet is down where you're at, there are other sources for the internet. There's restaurants all over the place that have access to internet. You don't even have to go into them. In Knoxville, we have Paneras you can go into. We have Chick-fil-A's, there's a lot, Burger Kings. Burger Kings have Wi-Fi. So my expectation is that you will hit that deadline. If you are having internet issues, you need to take care of them. Also, probably wouldn't wait until the last second to send this thing in. Don't be late. Don't be late. The other thing is, by the third case, I really shouldn't see any or very few grammatical type things. By this point in time, you all should know how to do a title page, and you all should not know how to do your references. Okay, that should not be anything that should be a surprise to anybody. The last thing, two things that I'll say is, number one, even though we're only going to do the 2 to 3 pages, but you need to try and identify all of the issues. Those of you that have seen this case already will know that there's a bunch of different parts to this. But the reason I use this case is because I want you to be able to make the argument why whatever you choose is the most important is the most important. And if you make a compelling argument, I'm not going to say you chose the wrong thing. Might not be exactly what I chose. And that's part of the discussion we're going to have when we come back. In 2 weeks, when we come back, part of the discussion should be in the groups, why did you pick what you picked? And there'll be a lot of commonality in it. There will be. At the end of the day, it comes out to be there's about 3 or 4 topics that people usually pick, and there's 2 of them that are picked a lot more than the other ones. Okay? But I don't want people to think that it's wrong if they choose something that is a little bit different. Now, the solution, the only thing that I will say is you all were a lot better at picking what I would call outside of the box solutions. But what your solution has to be, you can't say that what I'm going to do is knock down all the Bed Bath & Beyonds and just completely start again. Okay, that's probably not reasonable, realistic, and probably not going to happen. So anything that you come up with, you might want to take a step back and say, is that even possible? Is it possible that they could do that? It's okay. And I want you all to think outside the box in your solution to this stuff. But again, I want whatever you're thinking of to be realistic. Be realistic. We'll talk about the end result of what happens with that in 2 weeks. And like I said, the expectation is you send them in on that Saturday. I'll start working at them. I'm going to start opening them up as soon as I get them, because we've had a couple people send in empty files. And please don't send me anything but a Word file. You've all been pretty good about that. You've all been pretty good. The only thing I got was a couple empty files. But I'm going to need you to turn those around quickly. I don't really want to send them back during the week of Thanksgiving, because you all don't need to be worrying about that. Okay, I'll work on them. I'm going to send them back on the Tuesday after we discuss. Everybody clear on that? Questions? Comments? Concerns? If there are none, you all have a good evening. I'm letting you, well, okay, it's not that early. I wanted to go to 9. We're 2 minutes before 9. Okay. If we're good, see you all later. What do I do here? Just leave? Do I leave over here too?
Do you want to write?